two important things. Worldwide uranium demand has already increased to pre-Fukushima levels because of primarily Chinese construction. But importantly, the Japanese government has begun the permitting for another 18 plants in Japan. So the pace of Japanese restarts, rather than being a someday proposition, is a 2022 proposition. At the same time that every objection that I might have to re-entering the uranium market was answered, the price of uranium equities, which had become excessive, has fallen by half. So while the time question has been answered, the price of admission has fallen by half. This is just a unique set of circumstances in my life.
Hi, Rick. Welcome. How are you?
Albert, it's a pleasure to be on with you again. Thank you for hosting this.
It's good to see you again. It's been a while since we've done one of these. I know you've been traveling, and we have a lot to catch up on, Rick. Today, it's Friday, February 18th, and there's a lot going on. And what is interesting to me is that the narrative today is very different than it would have been, say, 6 months ago or a year ago. People who are watching know that all of the major U.S. market averages are down thus far. The NASDAQ being the worst hit, it's down over 13%. And there seems to be just sort of a reversal in the narrative that's persisted for maybe a year to 2 years prior to this. The narrative on growth stocks has shifted. That affects technology mostly, as well as crypto and some other stocks. The meme stock narrative has turned around. The pandemic play is now off. Inflation is now in play. And I want to get your thoughts on this because, I know you don't trade off of the macro, but certainly this is something that you must have noticed and have been watching to some degree.
Yeah, I mean, thank you for asking me that broad a question. It's way above my pay grade, but I'll try. The first thing I would say is I don't trade the technology stocks because I don't do things I don't understand. And I don't have enough of an ability in technology, as you well know, that I think I have any durable competitive advantage in technology. I will say, off the top of my head, that if technology falls by 25% in price, it is to me 25% more attractive, not knowing anything about the value. The meme stocks, I frankly never understood. The big ideas sort of stocks, I don't know how you value an idea. So I had no intention of participating in that market. I did notice in the broad market that as breadth became narrower and narrower, the billion-dollar market cap companies and the $500 million market companies became relatively cheaper at the same time that the market was going up. I didn't participate in that because my nervousness was that the broad market was going up simply as a consequence of low interest rates, higher capitalized value of distributions and lower cost of capital. And I was concerned about making a bet that focused on the continuation of unrealistically low interest rates. But I noticed as an example that a few household words, Berkshire Hathaway among them, is now trading at an 8.6% earnings yield. Okay, pardon me, 8.6 times earnings, 12% earnings yield. Okay, I have a sense of humor for that, particularly when there's $180 billion in cash that's earning them 50 basis points. That's not unattractive to me. So I'm starting to see some glimmers of hope in the broad market. At the same time, probably not coincidentally, that the narrative is souring. With regards to inflation, I think that the writing has been on the wall with regards to inflation for a fairly long time. But what we're seeing now is that the demand constraint that COVID put on the broad economy is beginning to fade away. And the consequence of that is that the true nature of inflation is beginning to show itself in consumer prices, which is normally the last place it shows itself. The producer price index has been strong for some period of time. And we've noted, too, the deterioration of faith in the dollar in various markets. But a circumstance where headline inflation is variously estimated by the government, not by me, at between 6.5% and 7.5%, reminds me of nothing so much as the situation that occurred in 1968, At that point in time, the writing had been on the wall with regard to inflation, and we began to experience inflation, but the consuming public paid no attention to it because it hadn't been a threat for the 20 preceding years. I think we're right there, Albert. People understand that inflation's back, but they don't understand how it bites you. When people begin to get bitten by inflation, truly bitten by inflation, then I think the attitudes of savers, investors, speculators, and even voters will change. I think we're on the cusp of that.
Yeah, and this inflation is creeping in all over the place, and people are noticing it in their energy costs, Rick. Maybe not in the, maybe consumer discretionary and some of those items, but certainly in energy costs, people are complaining. I'm hearing it. And with regards to tech, you may not proclaim yourself as an expert in tech, but whenever I'm dealing with an area that I'm not comfortable in, I just fall back on the things that I do know for sure that are universal. And you like to talk about mistaking bull market for brains. I think in this case, it's mistaking liquidity for brains. Yes. And I don't know if the market has really acknowledged that yet. And that is the amount, the largeness of the role that liquidity played in the run-up of these growth stocks and tech stocks in particular.
And Albert, that may continue because despite the Fed's talk about tapering, they aren't tapering. They're reducing the rate of the taper. And we still have deeply negative real interest rates. And we still have the uber availability of credit for anyone with a pulse and a decent FICO score. And in addition to that, while we are beginning to see corporate balance sheets take on debt, we see massive amounts of cash in corporate America. And among the individual investors that I talk to, the liquidity in the form of cash is truly staggering. While I'm concerned about many aspects of the market, and I'm concerned about many aspects of the economy, to the extent that there isn't a change in the near term with regards to confidence, there is so much cash in every part of the system that the liquidity you describe as driving the markets is likely to continue for a while.
I would wonder, though, if that liquidity would find a new home now that the market has been adequately spooked.
I'm hoping that the liquidity does find a new home. I'm hoping that investors who have been schooled by 40 years of good markets lose a bit of their hubris. In other words, I hope that fear returns to the market a little bit. Maybe I should substitute the phrase common sense for fear. But the discussions that I have with individual investors, and I have lots of them now that I'm retired, tell me that most individual investors still have too much confidence. Most of them are still making decisions based on their experience in the immediate past. Most of them, when I explain that we have lived through the most benign 40 years of economic climate that the world has ever seen, a period of declining interest rates, a period of increasing productivity from technology, a period where the demographic aid of the baby boomers was around, a period at least from the period 1980 to 1995, but perhaps 2000, where the growth of government was constrained. Government didn't fall, but the growth of government was constrained. A period in time where globalism and world trade increased, and a period of time when women entered the labor force, and a period of time, too, when emerging and frontier markets actually emerged. If you think about all the tailwinds that the economy had for the last 40 years, you'll understand something about investors' optimism. I would suggest to you that economic nationalism is beginning to replace free trade and globalism. I would argue, too, that the demographic boost offered up in Western countries by the baby boom is over. We're dying. We're not maturing. I would argue, too, that a period of 40 years that saw interest rates decline in the U.S. 10-year Treasury, as an example, from 15.5 all the way down to 1 before coming back up to 2, suggests that the tailwinds that we got from declining interest rates is over. In other words, I suggest that there's, in effect, an epoch change. It doesn't mean that the future is going to be bad. It just means the future is going to be different. And I don't think investors have made that shift because I think investors' perceptions are still set by their experience in the immediate past rather than by history.
Rick, you mentioned treasury yields, and I want to point out that this week we've seen sort of a tactical move towards treasuries and a corresponding reduction in the yield that is, for the time being anyway, suppressing a more strategic view that I think a lot of investors have, that they need to get out of these instruments because the trend is going to be rising interest rates. Is that a game that you play at all in terms of tactically, playing this move?
It isn't. I own a treasury ETF called Bill in very short-term treasuries because I personally have more liquidity than I'm used to. I don't own the U.S. 10-year because I don't own any long debt. But if you, Albert, the idea that I should trade bonds for capital gains and rely on stocks dividends for income flies in the face of everything that I've learned in 50 years as an investor, and I'm not going to play the game. The arithmetic around the 10-year treasury is lunacy. The only thing I can say for it is that the government absolutely promises to pay you, and they will. Who knows what they'll pay you with? They may print it up, they may conjure it, but they will pay you. That's the U.S. 10-year Treasury's sole remaining grace. But if you look at the arithmetic, even at the interest rate that prevailed 10 days ago, which was about 2%, the government promises to pay you 2% in a currency where they acknowledge that your purchasing power is declining by 6.5% or 7%. The attractiveness of that is a simple arithmetic function. You take 2% and you subtract 7.5 from it, or if you want to be more conservative, 6.5. The government is guaranteeing that they will make you less wealthy by 4% compounded over 10 years. My friend Jim Grant calls that return-free risk. Why would I do that, Albert? Why would I forego consumption in favor of someone else's consumption for 10 years, take credit risk, and then agree to be paid back less than I had paid them? This is true lunacy.
Yeah, the math on the surface doesn't seem to work out, and I've heard some really convoluted arguments around this question. One of them would be, well, if the maturity is far enough in the future, say not the 5-year, not the 10-year, but way out, maybe the market will turn around, yields will actually go full circle by then. Maybe we'll suffer through another ice age or something too and come out the other side just fine.
The discounted net present value of that, even at 6.5%, is too extraordinary for me to care much about. And to the extent, frankly, Albert, people are saying, well, they could easily cut the interest rate from 2% to 1%, in which case you'd have a capital gain in the bond. I don't trade narrative in return for safety and yield. I don't speculate in bonds. Bonds for me are for security of income and security of principal. And the bond market these days guarantees me that I lose both.
What about as an insurance policy? Because insurance premiums, if there's no event, guarantee you a loss as well.
That's a very different question. I am maintaining cash in some portion of my account, understanding that I'm losing purchasing power, but I'm not doing it as an investment. I regard the foregone purchasing power as an option payment. You've heard me say before, Albert, at least in private conversation, that as a consequence of having liquidity and experience, the 2008 squeeze was highly beneficial for me. I had both the cash and the courage to take advantage of a circumstance where the market lacked both. In a liquidity squeeze, he who has liquidity, as long as he's prepared to exercise it, comes out to be king. And I have reasonably large amounts of cash now, both because I've taken profits in various asset classes, but also because I think that the next year and a half will see a lot of volatility and may see a liquidity-driven squeeze. I regard the foregone purchasing power as an option premium. I don't regard my cash or bonds as an investment. I regard them tactically rather than strategically.
Okay, so there's the answer right there. And a sleep aid as well, Rick. Non-pharmaceutical sleep aid.
That is really a brilliant statement. I've had periods of time in my life where I had a lot of cash and periods of time in my life where I had no cash. And I was happier when I had a lot of cash.
Way happier. Way happier. Okay. I don't want this conversation to get too upbeat. We have a lot of things going on here. What I noticed is, last year or the 2 years prior, we were concerned about pandemic-related closures, what effect that's going to have on near-term earnings and whatnot. Now we have all these other kind of simultaneous risks that have emerged. You have liquidity risk, shrinking margins due to inflation, the risk of a recession should the Fed deliver and act on raising interest rates. And we also have political risk, not just in faraway places like Russia, but in Canada, where you just came from. I don't know. Are there any other risks that exist that I haven't mentioned yet? Because it seems like we're just in a crazy world now where everything is on the table.
I think you've given me enough. I do think that inflation poses risks, both in terms of increasing operating costs for companies, in other words, squeezing margins faster than they can raise prices in certain circumstances. In capital-intensive businesses, which I love, you have a circumstance where inflation is raising the cost of capital construction. In the mining business, I think that we're going to see capital cost blowouts that make the bankable feasibility studies that we've relied upon in the past look like fiction, where companies are estimating building costs based on their experience over the last 7 years. The experience that they're going to have in the next 3 years is going to be vastly different than what they had in the last 7. Similarly, I saw a preliminary economic assessment that crossed my desk 10 days ago, where they were using operating costs based on oil prices that they had enjoyed last year. Right. And I think that whoever authored that study may be in for a real surprise from inflation. I think, too, that as we discussed earlier in this discussion, there is a risk that investor behavior doesn't anticipate inflation yet, because although investors see it, they haven't felt it. Put yourself in the position, Albert, of somebody who runs a very large pension fund or endowment or insurance company. And 40 years of benign economic climate has told you that the correct asset allocation is 60% equity, 40% debt. And you are responsible for the well-being of your pensioners, your beneficiaries 20 years from now. And you wake up to figure out that 40% of your portfolio guarantees that your pensioners will be poorer. Even if you hold junk debt, the average yield on junk debt, the index is 4.7, in a currency that's depreciating by 6.5% a year. There's going to have to be major disintermediation in debt markets. And it's going to be messy. I don't know what's going to happen. I don't know what's going to happen to the cost of capital, as an example, for private borrowers. All I know is that there's going to be major disintermediation in debt markets. And there's going to be volatility as a consequence of that. I think a circumstance where pension funds feel an obligation to fully fund the pension benefits in a circumstance where they're losing purchasing power from debt means, as an example, that a pension industry that reports itself currently as $2.6 trillion underfunded probably is underestimating the underfunding by half. What impact that has on investor psychology, what impact that has on legislation, I don't know. But I know that the current state of real interest rates is going to have real ramifications that we don't understand. I look too, Albert, at the risk from the increasing politicization of society. I'm not taking the point of view of the right. I'm not taking the point of view of the left. I'm neither of those. I'm a libertarian. But increasingly, people believe that they are correct and that in their correctness, they have the right to prevail over other people. By political means. They don't have to convince other people to buy their products. They believe that they can compel and coerce them through the political process. And the fact that in the United States, both the Democrats and the Republicans believe that they have the rights to compel the other side to assume the ideological profile that they think is correct is scary to me. I believe that you are, as an example, beginning to see Caucasian people self-identify as white. In opposition to people who see themselves from other points of view. I believe that you are seeing a red and blue divide. It's becoming increasingly polarized because I think both people believe that they have the right to prevail rather than having a belief in live and let live and convince. We saw this in stark fashion 10 days ago in Canada, where Prime Minister Trudeau and Ms. Friedland, took it upon themselves to invoke emergency powers measures, to attack the bank accounts and insurance policies of people who they deemed to be ideologically incorrect. These were not people who were engaging in illegal activities. These are people who were providing sustaining capital to an honest political opposition. The idea that the government can publish people who are ideologically incorrect without going to the courts, without access to the rule of law, is Orwellian. It's fascist. And the idea that it's relatively popular in Canada is even scarier to me. I get perfectly if Mr. Trudeau had said, the convoy is an illegal gathering. And if Mr. Trudeau then had gone to the courts to obtain an order to vacate the streets of Ottawa, and once he obtained the court's permission, ordered the police to effectuate the order. I wouldn't have liked that, but it would have been a function of Canadian democracy that I had understood. The idea, however, that he was able to unilaterally invoke the Emergency Measures Act, compel the police to act without recourse to the courts or the rule of law, and then attack the private insurance policies and bank accounts of people who were implementing their rights to free speech and economic free speech is simply terrifying to me. I don't want to overstate this. I regard myself as a hot-eyed moderate. You know, I've always liked talking to Doug Casey because he makes me seem so reasonable. All of a sudden, he seems prophetic. And that does scare me. I mean, I have to say that scares me. And it also scares me that so many Canadian people who are polite and good and reasonable and intelligent are putting up with it. And that just astonishes me.
Yeah, I know. This has been brewing for a while, though. They've been
you've been telling me this, and I thought that you were part of a feedback mechanism where we only learned to listen to ourselves, where we didn't listen to the other side. Perhaps I was inured to reality by living for 40 years in a benevolent economic circumstance. Perhaps my own guard wasn't up. You know, in my own situation, Albert, in Canada, I was a property owner in Vancouver, a foreign property owner. And the voters took it upon themselves, because I was a foreign property owner, to increase my property taxes from 60 basis points to 560 basis points, charging me 5% a year of the assessed value of my house because I was a foreigner. And I used to joke that the first time society sends you a message that they don't want you, you should listen.
Right.
It took me 4 years to react to that, to sell my house. Mercifully, I did it before Mr. Trudeau had acted, because it likely would have lowered the selling price that I was willing to take for my house.
Good point.
And perhaps I should have recognized that the British Columbia and Vancouver voters were both envious and racist in the invoking those property taxes. And I perhaps should have regarded that as a free market Kristallnacht to understand what Canadian society was willing to endure and what, by proxy, the U.S. society is likely willing to endure, given the right that people believe that they have the right to govern each other by coercion rather than by persuasion. Is that gloomy enough for you? I think we've probably proceeded.
Yeah, it's maybe let me lift it out just a little bit. Someone mentioned to me recently that what happened there could happen here, and it most certainly could. That we are very similar culturally, but My hope is that the differences, and there are differences,
Yes.
as small as they may be, I hope are important enough, significant enough that that's what prevents it from happening here, because there is a difference.
I hope
people are willing to tolerate.
I hope that too, Albert, and I actually believe it to be true. But if you had told me 3 months ago that what the prime minister was able to get away with, he would have been able to get away with it, I would have said, no, Albert, you're being dramatic. So I hope I'm right. Listen, we've had this discussion before. I'm a big picture optimist. And for the same reasons. The United States has traditionally been a place where, as we've said before, 6 pimply-faced kids can commandeer a garage in Sunnyvale and out pops Google. And the world is getting better in the sense that there's greater female participation in the labor force, and there's greater participation from emerging and frontier markets. I mean, it's entirely likely now with technology that garage could be in Lagos or Da Nang or La Paz. I mean, I think all that's wonderful. And I still believe over time that our individual creativity and tenacity will likely finance our collective stupidity. It's just I'm afraid of what happens between now and then.
Exactly. There's an ebb and a flow.
Yeah.
And society's long run is not necessarily ours.
Yeah.
We're stuck in our time.
Yeah. Right.
There was something you mentioned before, so not to do with politics. Let's steer back to investments. You are a follower of Warren Buffett, sort of a descendant of the Graham Dodd style of investing. And you said something interesting at the beginning of your comments just now. And that was, I love capital-intensive businesses. And I can understand that given how good you are at investing in these markets. But those businesses are what many people, including Buffett, consider very bad businesses. And they're even worse, as you pointed out, during times of heavy inflation. Warren Buffett only wants to buy the company once, right? Seize candy. He doesn't want to keep buying it over and over again to replace depreciated assets. Do you ever, I mean, it's worked out just fine for you, but do you ever look at the markets and think, oh, the grass is certainly greener on the other side, these wonderful businesses that require no capital, especially during times of inflation? It would be nice if that was your area of expertise.
Well, Albert, you and I are growing one. Rule Investment Media.
Yeah.
It's a knowledge business. And I've grown several financial services businesses. And I like them too. I like any business where I feel like I have a durable competitive advantage. I understand financial services. And as you know, I'm starting a new bank, an odd thing to do in retirement at age 69. And a new media company. But I like capital-intensive businesses too. And it's important to note that Mr. Buffett has changed his tune. Mr. Buffett is now talking about things like brick-and-mortar bonds. Which is to say railroad businesses where the accumulated value of your installed capital goods goes up because of inflation and creates a barrier to entry from new entrants. And Mr. Buffett has even said that the regular yields that one can expect on capital-intensive businesses are becoming increasingly attractive to him. That as a check writer, the fact that capital-intensive businesses often have higher costs of capital is attractive to him because he's a provider of capital. There was a point in time in the 1980s in particular where the value of high return on capital employed and franchise wasn't rewarded in the market. And so Mr. Buffett could buy brands like Coca-Cola or Columbia Pictures and pay no premium for the brand moat around the business and pay no premium for the very high margins that the company enjoyed. 40 years of benign economic climate has meant that while those advantages still exist, he isn't buying them for 6 times earnings anymore. They're being offered at 40 times earnings. And what Mr. Buffett, I think, has decided wisely is that a volatile, capital-intensive return on capital, a 15% return on capital employed, beats a low capital intensity 4% return on capital employed, as is implied by enterprise value. So I think Mr. Buffett's response has changed both with his ability to write checks, but also because the valuations of the businesses that he once favored have gone so high that he doesn't feel like he can afford them anymore.
That's very interesting. And I find it very, I guess, I'm very fascinated by the way he and Charlie Munger have continued to learn and evolve deep into their 80s and 90s even. As the markets have changed, as conditions have changed, and like you said, as the size of their enterprise has changed, it's been very interesting to watch over the years.
As long as we're on the topic of Munger, I don't know if you saw the recent interview by Mr. Munger about the dangers of inflation and the possible outcomes for America. This was an interview that had Doug Casey given it would have been chilling. The fact that Mr. Munger gave the interview, while I believe all of it to be true, and I believe him to be a smart guy, the candidness of his warning astonished me. I don't know if you saw the interview.
I didn't see the recent one. I didn't know there was a recent one. I know he's getting quite up there in age and limiting his activities. But even years ago, when faced with the question of inflation, he goes right to World War II Germany. Like he says, like, look, you think prices are scary. What's scary, really scary, is what happens socially and politically as a result.
Well, he said it again. He said that other than nuclear war, the greatest immediate threat to humankind is inflation and, quote, the politicization that leads to inflation.
Yeah.
And he's a pragmatist. He's not a libertarian.
Right.
He also said that
Rick.
he also said that his operating thesis is that the dollar will lose 100% of its value in 100 years because it lost 98% in the last 100 years. And he said that societies get what they ask for, that the reward that the Germans got for Weimar Germany was Hitler. He said that in an interview.
Yeah. No, I heard that before in a different one. Yeah. He's been consistent.
This is astonishing from a guy like Charlie Munger.
Well, like you said, he's very intelligent. He may not identify as a libertarian or an Austrian. Yeah. And I don't think his economics are, frankly, that on point. But there's certain things that we all agree on that anyone can put together, any reasonable, rational person can look at and conclude if they're intellectually honest enough. And he certainly is. And but the way he does it is interesting, too, because I don't know if he did it at the end of the interview you're talking about, but in other interviews, he'll say something like that. And then he'll say, but you shouldn't be worried. You should, if I'm almost dead and I'm happy, why should you be upset about paying a little bit more?
Well, he's referring to tax there. I think that Munger has come to be concerned about nearer term outcomes in society as a consequence of people's lack of understanding about the conditions that they inhabit, including inflation. I think he's concerned about social discord as a consequence of inflation, as he should be.
Yeah.
Many households in the United States are having a very difficult time maintaining their lifestyle after the 40 most benign years in human history with regards to the economics. If the circumstance became less benign, and I would suggest that 7.5% compound inflation is anything but benign, the potential for people experiencing real declines in their standard of living and resenting it is pretty high.
Yeah. Let me get one more kind of off-the-wall question for you before we move on to just a more standard discussion about resources. You mentioned that you were a business proprietor. You were in the restaurant business years ago. And I'm wondering if you were still in that business today, sole proprietor, running a restaurant bar or something like that, and you were faced with the inflationary economic outlook here. What would be your attitude? How would you approach something like that?
Despite the fact that I disliked the restaurant business, I was pretty good at it. And if I had the same competitive skill sets in the restaurant business now that I had then, doubtful, by the way, I would stay in it. For some reason, people are willing to pay for that which amuses them and resent it less than paying for what they need. Somebody was willing to pay me in those days $10 for a steak served to their table when they'd scream bloody murder to pay $1.50 for that steak at the store. It's odd that people have less resentment over paying too much for things they don't need relative to things they do need. And ironically, the restaurant business, at least a restaurant business that services a high-end clientele, which mine did, is more inflation resistant than a business that's built around the necessities of life. It's odd that selling luxuries is more recession proof than selling necessities. So from a macro point of view, I would probably do exactly what I did. Now, you need to understand, Albert, I was competing in Vancouver in a circumstance where the median quality of the restaurant owner was substantially less than it was today. And one of the reasons that I succeeded is that the bar was so low, it was difficult to get under it, not over it. That's all changed.
Yeah.
Two, I came to understand the basics of the restaurant business. I learned that other people were more efficient than me, so I needed to have an edge. I learned, as an example, that I didn't make much money on entrees, and I made a lot of money on hors d'oeuvres. When I bought the restaurant, we had, 45 entrees, and we had 6 hors d'oeuvres. Pretty quick, I trimmed the number of entrees I had to 10 or 12, and I increased the number of hors d'oeuvres I had to 35. I learned, too, that one of my skill sets involved putting butts in seats. That is to say, volume hid sin. And I was very good at making my restaurant fun and letting people know that it was fun. So I was pretty good in business at playing to my strengths and finding ways to compensate for my weaknesses. And I suspect that were I in the restaurant business today, I could probably find a way to do that. The bad news about the restaurant business is I hated it. And so getting out of it was a very good thing for me to do.
I suspect a lot of restaurateurs are going to be struggling, though, in what's coming. I mean, I went to Rick. I went to a donut shop. Don't ask me what I was doing there, but I was in a donut shop in LA last 2 weeks ago, and the owner. This is a mom and pop, typical Southern California mom and pop donut shop, and the owner had posted 2 charts of commodity futures for, I forget what it was, wheat and corn or something else, wheat and sugar or something like that.
Sugar, sure.
He posted it at the cashier as an explanation to people as to why their prices were going up.
To justify his price index. That's great.
Is that great. Crazy?
That's great.
We're all economists now.
Mm-hmm. Well, I think that's wonderful. I hope that some of his customers pay attention.
Based on what I saw in there, I don't think so. But kudos to him for trying.
Yes.
Let's move on to resources and let's start with the precious metals, Rick, because like I said, strategically, it looks like people are gearing up for rising interest rates stoked by inflation. Gold is up 3 or 4% this year. I'm wondering why it's not up more. Any thoughts on that?
Yeah, I do have some thoughts on that. Cyclical declines in secular bull markets, extended ones, are a common focus of gold bull markets. We saw them in the middle part of the 70s. We saw them too in 2002 in that market, again in 2008, although that was there were extenuating circumstances around that. Gold does well when people are concerned about the purchasing power of their savings in fiat instruments. And confidence has been very high, even over the last year in the United States. Speculative activity in all kinds of things, cryptocurrencies, technology stocks, meme stocks, as you suggest, has been rife. And many people have come to believe, as a consequence of 40 years of benign economic climate, that one defense against inflation is the S&P 500. And the performance of conventional financial assets and the unwillingness of people to recognize the trap that is the bond market in the face of inflation has meant that people's psychological need for gold has stayed small. I believe that's over, and I believe it's over now. There have been 3 times in my life where the gold price did well in the near term in the face of rising interest rates and a stronger U.S. dollar. And every time that has happened in the past, we've seen gold go on a romp. There is a truism that gold goes up in an elevator. It goes up suddenly and steeply. It goes down in an escalator. And gold doesn't give you much forewarning before it goes up. But my experience has been when you see gold raise in U.S. dollar terms and the U.S. dollar is strong, gold has already been performing in other currency terms. And I think that we're in just that circumstance now. The specter of higher interest rates and the reality of a stronger U.S. dollar relative to other currencies, and the concomitant increase in gold in the face of those other two factors, tells me that gold is ready to rip. I haven't said for a long time that gold was ready to rip. What I have said is that the wind, for several factors, for several reasons, the wind is in gold sails. But I haven't known whether the trade is timely or not. Now I believe the trade is timely, too.
That's a good point, that a rising U.S. dollar can conceal, I guess, an otherwise bull market in gold. But your point about equities is true. I mean, equities are a long-term great hedge against inflation if you're willing to dismiss all the ups and downs, the huge drawdowns you get from time to time in equities. And I guess if we haven't had one in a while, people forget that that is one of the pitfalls of using the equity market as your sole hedge against inflation. And so to your point, if we do get a big drawdown this year, which very well could happen. I mean, there's so much headline risk. There's the Fed looming out there. It could come anytime. People will be, I think, reminded once again why, if you want a true hedge against inflation that doesn't involve bringing in other types of risk, this is the way to do it. Your thoughts on the GDX being up a little over 7%? I guess that makes sense given sort of the performance.
I think it's way overdue. I analyze gold stocks fairly simply, which is to say, my first screen is net present value. I define net present value as future cash flows from defined reserves and resources that are developed or are developable relative to enterprise value, which is market capitalization plus net present value. If you measure mining stocks by that metric using current gold prices, they are as cheap relative to the price of gold as they have ever been in my career. If you measure them by free cash generation relative to sustaining cap, they are the cheapest that they have ever been in my career. So at the same time that I feel very good about the denominator in the equation, which is to say I think the gold price is going up, I think the silver price is going up, the numerator is cool too, because the ability to play that game is as cheap as it has ever been. Now, I'm not talking about the fact that I think penny dreadful exploration companies are wonderful hedges against inflation. That's not what I'm talking about. What I'm talking about is established producing companies that have 10-year reserve lives, that have reasonable all-in sustaining costs, and that are generating 3% free cash flow yields net of sustaining capital investment. I think you need to be in gold as an insurance class, and I think if you are an investor, investing in an asset class that is cheap, that is newly sober, who knows how long they stay sober for, where the selling price of their product is rising, is a reasonably good, not a reasonably good, I think it's an excellent investment, particularly given the lack of alternatives in the broad market.
Rick, when you're doing your calculation, do you use the spot price of gold, or do you use some kind of moving average over many years?
I use the spot, and then I use the forward strip. A lot of people have a lot of opinions as to the gold price, but I have found that the opinion that I value the most is one where somebody wrote a check to give their opinion.
Yeah,
and the futures market doesn't reflect a consultant's opinion. What it reflects is an opinion that somebody has a strong enough feeling about that they've written a check to support it. And while it's never wrong, in my experience, it's closer to right than any other mechanism I have access to.
Right. Okay. And then quickly moving to the juniors, Rick, haven't been keeping up this year anyway. Are your thoughts on that?
Shouldn't be keeping up. The juniors, if you take a look at the length and breadth of the market, as a class, have no net present value. If you merged every junior in the world into Junior Explorco, that company in a good year would lose $2 billion, and in a bad year it would lose $10 billion. The sector as a class has no value whatsoever. That hides the fact that probably 5% of the issuers generate so much value that, as I'm fond of saying, they add legitimacy and sometimes even luster to a sector that loses $2 billion a year. There are some wonderful values that are beginning to emerge in the junior space. I don't think that you're going to see the junior sector as a whole levitate for at least a year and a half. I think the leadership will have to come from the real gold companies. I think speculators who are willing to do the work and understand the individual values in the sector will do very well in the exploration stocks. And I'm allocating personally to them now.
Okay, that's a point you've been consistent on for as long as I've been following you. Not a market that you want to index.
It's suicide.
Yeah.
If you look at a business where year in, year out, it destroys capital. The very poor performance of the industry as a whole, however, disguises superb performance from individual management teams and issuers.
Okay. Let's move on to what I really wanted to talk about today. That's energy, and in particular, uranium. And the reason I want to talk to you about it is because you've had a change of opinion recently. I know you were bullish on uranium, but as recently as 7 months ago, you were bearish. And now we're actually hosting an event later this month on uranium because you're bullish now. So first of all, can you explain what the thinking was? Why the reversal?
You and I need to have a cocktail in celebration. After at least 10 years of working together, we got our timing right finally once. And I'll explain that. The arithmetic around uranium continues to be very good. You heard my thesis 3 years ago, and you helped me broadcast it. Uranium is a commodity that's necessary for the continued well-being of man. Ms. Thornburg and Ms. Merkel notwithstanding. Uranium generates 14% of total electrical demand in the United States and 20% of baseload demand. And it's important worldwide too, which is to say that the simple equation around uranium is if it isn't around in sufficient quantities 5 or 6 years from now, the lights go out. The lights aren't going to go out. The uranium price is going to go up. A few things changed. 3 years ago, I said I knew it was going to happen, that it was an if question, not a when question, but I had no earthly idea about the when. Now I do. 2 things have changed, Albert. Well, 3 things, really. 3 years have passed, which means that some of the when has gone by, simply by history. Secondly, our former employer, Sprott Inc., launched the Sprott Physical Uranium Trust, which was an enormous success, raising $1.2 billion in 4 months, buying 20 million pounds of uranium and buying it by itself, tightening up the spot market. And the political winds of change are blowing strongly in Japan. It was, of course, the Japanese shutdown post-Fukushima that threw uranium into the doldrums. Japan is the second largest consumer of uranium historically, and they've restarted 11 of, if my memory serves me well, 42 plants. 2 important things. Worldwide uranium demand has already increased to pre-Fukushima levels because of primarily Chinese construction. But importantly, the Japanese government has begun the permitting for another 18 plants in Japan. So the pace of Japanese restarts, rather than being a someday proposition, is a 2022 proposition. At the same time that every objection that I might have to re-entering the uranium market was answered, the price of uranium equities, which had become excessive, has fallen by half. So while the time question has been answered, the price of admission has fallen by half. This is just a unique set of circumstances in my life. You'll recall that a year and a half ago, I thought the uranium stocks were dirt cheap. But the poorest quality uranium stocks in particular increased on a narrative-based trade by 400%. And although I believed that the outcome was good, the price of admission was too high. And the consequence of that was that I sold effectively all my speculative uranium portfolio beginning 9 months ago. And for once in my life, I guess I got the timing right. The uranium equity index has now fallen by half at the same time that the catalyst has been put in place to see the bull market return. Now, I have a secret weapon, Albert, that you helped me create. I have an investor database of 68,000 people, many of whose portfolios I have graded. Between 7,000 and 8,000 of those portfolios have been uranium-centric. And by looking fairly carefully at the data in that database, I've been able to I think pretty well determine what investors get right and what investors get wrong, both in terms of investment selection and criteria, but also in terms of investment timing. And that has allowed me, with your great help, to put together the Uranium Bootcamp on March 19th. It isn't merely that our timing is right. It isn't merely that the subject is right. But the curriculum, the course curriculum in the boot camp is tailor-made for the 7,000 or 8,000 people who have come to me looking for help with their uranium investments. We will have the best overview of the uranium market that money can buy. I've sat through the presentation. WMC, who are the consultants that Sprott use, put on a uranium market overview for the Sprott board that was the single best overview that I've seen in 40 years of studying uranium. It's just superb. And this is the first time that this overview will ever be presented, maybe the last time that it will ever be presented to a retail audience. It's just beyond words good. This overview is worth the whole price of admission. But as you know, we're not stopping there. We'll talk about the global politics of uranium. The biggest new player in uranium is China, and we'll hear from China General Nuclear, the Chinese parastatal that is the nuclear industry in China. We'll hear about supply and demand dynamics from Kazatomprom, the largest and lowest cost uranium producer in the world. We'll hear about the structure of the uranium market from Cameco, the largest market cap uranium producer in the world. We will hear from John Ciampaglia, the CEO of the Sprott Physical Uranium Trust, who I would argue has become the single most important person in the uranium spot market in the world. There will be 8 hours, I think, of content in this that isn't merely uranium content. It's content that is directed absolutely at the shortcomings that we have seen in between 7,000 and 8,000 actual portfolios constructed around uranium. I'm really excited about it. I mean, I would be excited about this product if I thought that uranium was temporarily overvalued, because I think that this will make people better uranium investors for 10 years. But the fact that it's timely, the fact that it is geared to this quarter, is enormously exciting to me.
Rick, it's interesting that you've had visibility into so many uranium portfolios of your followers, but I think what people watching this and people who are going to attend this event would be some visibility into your uranium portfolio. So I'm wondering, what kind of discussions will you have during the conference about your own portfolio and what you look for?
Well, let's start by saying there's no exhibitor here that I don't own. Kazatomprom is my largest uranium holding. Cameco is my second largest. China General Nuclear is my third largest. But the smaller companies, the next gens of the world, the fissions of the world, the deep yellows of the world, all populate my own account. I have never, as you know, Albert, accepted a conference sponsor or a symposium sponsor that I didn't own. There is no guarantee that because I own them, the stock price goes up, sadly. But there is a guarantee that I've studied the company well enough that I've been willing to invest my own money or Sprott's money in them. Which means that every sponsor in this conference will be vetted, which I think is useful. But you will also find that all of the exhibitors here will have to endure an interview by me personally. What I found is that many companies can be good presenters, but because they're busier running companies, they don't know how to address an audience well. And when I analyze the companies myself, when I ask them the questions, they end up giving a more investor-friendly presentation because I've spent 40 years talking to investors while they've spent 40 years running uranium companies. So one thing that investors can look forward to, in addition to the broad-based content around the politics of uranium and the structure of uranium markets, is an insight to how uranium investors and speculators, at least according to Rick Rule, should think. Certainly an exposure as to how I think, the questions that I ask, and the questions that I'll be asking on behalf of the attendees to the exhibitors who have had the courage to subject themselves to the scrutiny.
All right, sounds good. So that is March 19th. Link will be in the description below. We certainly hope you can all attend. It's going to be a lot of fun, Rick. Any parting thoughts for the viewers?
Yeah, I want to be more aggressive with this. If you are a speculator, you should be in uranium. And if you are a speculator who does as he or she should do, you need access to the uranium business. Investors are woefully unprepared to do what they're proposing to do. This is an IQ test. Don't fail. And I'll go further than that. As you know, Albert, in every conference, in every symposium, in every educational product that I've ever offered up for pay, I've had an unconditional money-back guarantee. Anybody who attends this symposium, who pays us the $99 to attend and doesn't feel like they got their money's worth, all they have to do is email us and say, you know what, I came, but I don't think I got my money's worth, and we'll refund your money. The financial risk is mine.
Yeah, it's really hard to beat. And we've had that offer out there, for the other conferences we've done, and people have been satisfied. So
thanks to you, Albert, the production quality has consistently been high. The content has always been honest. We have never allowed an exhibitor into one of our conferences or symposiums that we didn't own with our own money. There's a reason why we haven't had to give any money back, because we put out damn good product.
Agreed, Rick. Please check out the link below. I'm sure this will be of value to you. Rick, thank you very much for your time. We went a lot longer than probably you were intending, but I appreciate it, and look forward to doing it again.
It's a pleasure, Albert. We have to do much more of this.